going to tokenize. And they're going to issue it to you through the central bank. And the ECB, specifically in Europe, wants to do this direct to consumer. There'll be maybe intermediaries that kind of facilitate those transactions, but they want to cap how much you can hold. They will have access to the information around where you were and what you did and what you spent your money on. They can tell you what you can spend your money on. You can buy that, but you can't buy that. So ultimately, the financial system is moving toward tokenization, whether we like it or not. And so I started by saying we've got optionality, we've got choices. And so the more choices, the better, that allow us to transact how we want to transact. But the idea that everyone in this room isn't going to have access to, potentially forced to use, a digital wallet at some point, would you rather use an asset that provides some level of privacy and control, or do you want to use an asset that's given to you by the government that, the country that you live in, and told how you can spend your money?
Silicon Valley Bank failed on a Thursday night. Within a couple of days, Credit Suisse had been forced into a shotgun marriage with UBS. How long after that, and of course Signature Bank also failed that Sunday night back in New York, how long did it take before you felt like everything's going to be okay?
Well, I think there is a general question that any times you dent trust and confidence into the system, then you worry. Because at the end of the day, banks are built on the trust and confidence. So that for me was the key issue. Is the broader market not understanding exactly what triggered the situation going to say we have another 2008 and therefore all the banks have the same issues? And the market reaction was exactly in that direction. But when you look at the issues that triggered that, at least for example in the US, liquidity, interest rate, mismatches, and we just could not be doing that even if we wanted to, and we do not want in Europe. So it does not apply. What applies is a read across that affects confidence. So let's say that we were convinced that we were in a solid position quite quickly. What we were worried about is the contagion by the lack of trust, of confidence. I think that the ECB just keeping its direction with rate increases.
Not blinking.
Not blinking, authorizing us to distribute 3.35 billion of share buyback to our shareholders. That's about 10% of our market cap, kind of underscored with facts that the situations are very different.
I grew up at a time that was in 2008, right, when the US was actually entering a recession, right? So we had a very strong focus at the time on fundamentals in businesses, meaning companies that were either profitable or had a path to showing profitability. What I saw in the last decade, maybe in the last 5 years particularly, was sort of an abandonment of that focus as companies were chasing sort of hyper growth for extended periods of time. What I think the collapse of SVB means is a lot of investors are going back to those fundamentals and looking probably with higher scrutiny today than they were over the last few years for businesses that actually have demonstrable proof of a profitable revenue plan.